What's going on, guys? My name's Emmanuel and welcome back to my channel. In today's video, guys, we're going to be taking a look at my top 5 safest dividend stocks that you can buy today, or at least add to your watch list and keep a close eye on. And if you stick around to the end, I'm going to give you one more bonus stock that you can add to your list. It's been a crazy few months. We've seen the Bank of England step in and literally instruct all of the lenders to stop paying dividends immediately. Major companies all across the world are suspending their dividends at the fastest pace seen in years. So for this video, guys, the emphasis will be on dividend sustainability, dividend history, dividend growth, and most importantly, the company's financial strength and also the company's moat. But before I hop onto the laptop, guys, please give this video a thumbs up. It really helps my channel grow. And with that said, let's go. Alright, guys, so the first stock we're going to be looking at today is Microsoft, ticker symbol MSFT. And I always like to start with the fundamentals. So again, we want to know what the story is. And, pretty much most people will be familiar with Microsoft. They used to be known predominantly for their Windows operating system, so Windows 95. We've had some good times on that. But now they've actually diversified. They've come a long way since just Windows 95. They're a powerhouse player in the productivity sector, in the cloud service sector, and also personal computing sector. So that's, for example, that's the gaming, Xboxes, and office-based products. If you actually look here in terms of their revenue, where they generate most of their revenue, you can see Microsoft are pretty well diversified. 26% of the revenue comes from their server products, 25% comes from Microsoft Office, so that's PowerPoint, Excel. Again, 16% of the revenue comes from Windows, 9% comes from gaming, so that's Xbox and Xbox games. 6%, which kind of surprised me, to be fair, 6% comes from search. So I'm guessing, well, judging from my research, is Bing searches and advertising on Bing. LinkedIn, 6%, and other enterprises and others as well, 7% and 5% respectively. And that's what I really like about Microsoft, and that adds to the safety of the dividends, is that the fact that Microsoft is well diversified. All right, guys. So the next step is to look at competitive analysis. And if I just scroll down right now, you can see a massive difference between Microsoft and Apple. Apple's revenue is heavily, when I mean heavily based on iPhone sales. 60% of Apple's revenue is to do with iPhone sales. And if you think about it, we're currently still in a lockdown here in the UK. The iPhone sales are going to drop. People can't go out and test the new iPhones, and it's going to take a huge drop, which means 60% of Apple will take a huge cut in terms of the revenue. That's crazy. And then you've got 14% here services, 8% is Mac, iPad is 7%. And then 11% of the revenue is from wearables, so that's the watches. So that's why I think Microsoft, although they're a cheaper company in terms of market price, I think they're at a bargain in comparison to Apple. Alright, guys, and one further fundamental that I would like to bring to your attention: if you have a look at the annual report for Microsoft ending last year, they've highlighted the current breakthroughs and where they're going to be progressing. So I particularly like that they're focusing a lot of their attention as well on artificial intelligence. I strongly believe AI is the future. Alright, guys, so regarding dividend safety, Microsoft has a dividend safety score of 99, which is the highest. This website, Simply Safe Dividends, it's a group of analysts, and they rate a company's dividends, and they give it a score from 1 to 99, 99 being the highest. So it has the highest rating from top analysts regarding their dividend safety score. Alright, guys, so moving on to the yield. What kind of yield can you expect if you were to own a Microsoft stock? It's not great, guys. It is low. It is at 1.11% dividend yield. So Microsoft is a growth company, guys. When you do invest in this company, it's not necessarily entirely for the dividend yield. It's for the growth. Microsoft still has a lot of growing to do. And if you consider a lot of growth stocks, for example, Amazon, Amazon's a huge growth stock and they don't even pay their shareholders a dividends. So the fact that Microsoft, we are still getting a 1% return on our money every month in terms of dividend payments, the fact that there's going to be a lot of capital growth with this stock, makes it firmly placed and should be in at least your watch list. Taking a look at the dividend growth, and again, it's been phenomenal. Over the last 10 years, the dividend growth has gone, well, it's at 13.77%, which is quite high over a 10-year period. Over a 1-year period, it's up 9.8%. Over a 3-year period, it's 8.74%. And 5-year growth is at 10.45%. Taking a look now as well at its history here, pretty much puts into view the growth as it's experienced since 2002 all the way now to 2020, and it's sitting at 51 cents a share. So they have grown their dividends quite rapidly. And I mean, this is something that you would expect Microsoft to continue. They're not going to be affected too much by the current pandemic. All right, guys, and before we move on to the next stock, we'd like to take a quick look at the financials. They have a PE ratio of 30.71 as of time of recording, which pretty much means in terms of your return on investment, it will take you about 30 years to get a return on your investment. The net income for Microsoft has seen year-on-year growth. It's incredible in terms of an income statement. In 2016, it was at 16 billion. And remember, guys, all these figures are times by 1,000. So it's sitting at 16 billion in 2016, and we are now at 2019, and the net income is 39 billion. That's incredible growth, guys. Revenue as well has grown year on year. So the management are doing an excellent job in terms of controlling the income. Also, taking a look at their balance sheet, guys, one of the first things I look at before investing in the company is I start to look at their total current assets, because that gives me a good indication of how the company will survive within the next 12 months. So if Microsoft were to liquidate and sell all of their assets, they have 175 billion in total current assets that they can liquidate. And that's important because when you take a look at the current liabilities are sitting at 69 billion. So the current liabilities are the financial obligations of a company within the next 12 months. So if Microsoft were to get into trouble now, they're not in danger of going bankrupt anytime soon because their assets pretty much can cover their liabilities. And taking a look at their stockholder equity as well, guys, as with everything, it's been going up year on year. It's been positive, and with an increase in stockholders' equity, that's an indication that the assets are growing much better and faster than the liabilities, which is always a great sign. Taking a look at Microsoft's cash position, they have 133 billion in cash, and their current long-term debt is 66 billion. So again, they have more than enough cash to weather the storm. It's just a phenomenal business, guys. Last but not least, they have an operating margin of 37.46%, which is brilliant. That means for every $100 the company make, they keep $37 as earnings. So that's a great operating margin. Current ratio is sitting at 2.9. And if you wanted to buy a Microsoft share on Trading 212, you type in the ticker symbol MSFT, click on Microsoft, click on buy. And if you want to buy one share will cost you £148.27. Guys, so the second company we'll be taking a look at today is Medtronic, ticker symbol MDT. And I will say right off the bat, I do have a medical background. So on the annual report, they claim to be one of the world's largest medical equipment device companies in the world, and I can stand by that. A lot of the equipment that we use in the hospitals are produced and created by Medtronic. So as a result of that, their products help treat over 40 medical conditions, and they do touch millions of patients worldwide. Their main clientele, therefore, are hospitals, surgical centers, home care, and long-term care facilities. And in terms of having that as your clientele, that's a pretty solid clientele. It's a clientele that can weather all types of global crisis because they are essential clients essentially. So how do they generate their revenue? So bulk of their sales, of course, comes from medical products. And if we take a look at their annual reports, taking a look at the annual report of 2019, you can see here that the bulk of their sales for last year and the prior years have been cardiac and vascular groups. Second were minimal invasive therapies. They do respiratory, GI, and renal products as well. And again, restorative therapy groups is also a huge bulk of their sales. So going back to this, number one is CVD. So again, cardiovascular disease, and the reason why it's the biggest bulk of their sales is because according to the World Health Organization, CVD is the number one cause of death globally. And they've also actually been quite innovative with their CVD medical equipment. So they create MRI conditional ICDs. See, a lot of their new ICDs are now compatible with MRI conditions, pretty much most of them. All right, guys, so moving on to their dividend safety. According to Simply Safe Dividends, they have a dividend safety score of 99. Taking a look at their dividend yield at the time of recording sits at 2.45%, which is pretty much double of Microsoft. Their dividend growth rate, as you can see here, has been growing. Their 10-year growth rate sits at 13.50%. Taking a look at their dividend historical chart, you can see it's been steadily on the rise since the year 2000, essentially. Started off at 5 cents a share, and it's now currently sitting at 58 cents a share. So pretty much on in line with Microsoft, but it's much cheaper, so the yield is much better at over 2%. Also, good news regarding their dividends, guys. They released an article recently announcing that they're going to actually increase their dividends, which is not surprising since we have a global pandemic to do with the respiratory system, and the second bulk of their sales is within the respiratory equipment devices. So that's a good bonus. And taking a closer look again, guys, at their financials, they have a PE ratio that sits at 24.33, which is slightly higher than I usually like. I usually like to aim for 20 or below, but they are an essential service. Taking a look at their current 52-week range, their price is sitting 20% below its 52-week high. Looking at their income statement, again, their net income has been quite steady. I wouldn't say it's had significant increase. As you can see, it was at 3 billion in 2018, 4.6 billion 2019, and currently the first quarter of 2020, according to their TTM, which is the trailing 12 months, they're currently on par to make 4.7 billion. So to determine their financial strength, we want to take a good look at their balance sheet. Their total current assets is sitting at 22 billion. And their current liabilities is sitting at 10 billion, which is really good. Also, taking a look at their stockholder equity, it's been kind of stagnant. I'm not going to lie. It's not really that impressive. Their total assets and total liabilities seem to be growing at a similar pace, and we like to have situations where the assets are growing much quicker than the liabilities. And also, guys, looking at Medtronic's insider transactions, as you can see, the directors have been quite busy awarding themselves with shares. So that's always a good sign when there's insider activity and the insiders are actually acquiring shares and gifting themselves and granting themselves stock. It's it's a good sign. So the company's in the right direction. And lastly, guys, if you wanted to pick up some shares in MDT, you can always use Trading 212. Type in MDT, the ticker, and to buy one share of MDT will cost you £78. Alright, guys, so the next company in my list is PepsiCo, ticker symbol PEP, PEP. I'm sure we're all familiar with Pepsi, but if you're not, they're a food and beverage company. And recently they have the largest market share in 4 of the top 5 geo regions, which pretty much gives them a wide moat in comparison to their competitors. This again was sourced from the investor presentation that you can find
on their website. So again, this actually quite was surprising to me how they generated their revenue. So if you take a look at the annual report, you can see here that 54% of PepsiCo's revenue was generated from food. Now, I'm not sure about you, but I pretty much know Pepsi really only for their drinks. So I was quite surprised to see the percentage difference. You know, that majority of their revenue was from food. When I was doing my research on this, it was interesting to see the amount of acquisitions Pepsi have made over the years, and the Quaker brands, Frito-Lay, Doritos, pretty much they're all under the PepsiCo umbrella, which was quite amazing. Now, when you look at the competitive analysis, and this is why I chose PepsiCo over Coca-Cola, is, you know, the soda beverages sector of Coca-Cola makes up for 70% of Coca-Cola's revenue. Whereas with Pepsi, as you've seen, you know, they're well diversified in food products, and they're also well diversified in the beverage products. So they're more diversified. So I like to see Pepsi as Microsoft and Coca-Cola as Apple, if that makes sense. Quickly moving on to their safety score, they actually have a lower safety score in comparison to the other two companies we've looked at. But one thing you will notice, guys, with the dividend safety score, the lower it goes, the higher the yield. I found that to be true in a lot of companies. Even though it's at 93, I still consider PepsiCo very safe, well diversified. Taking a look at their dividends, so currently their yield is sitting at 3.13%, which is as of recording today, which is quite high. It's much higher than the other two companies that we've looked at today. They've also been growing their dividend growth rate, sitting at 7%, which is probably the lowest as well of the two, but not really put off by that, because if you look at their overall history, you know, they've been growing it quite beautifully, um, to where it's now sitting at $1 a share. That's incredible, you know, at $1 a share. As you're probably accustomed to now, guys, we quickly take a look at the financials. PE ratio sitting at 25. Pepsi is currently down 11.91% on its 52-week high. Okay, so taking a look at Pepsi's income statement, good sign is they've been growing their revenue year on year, but their cost of revenue has also been growing, and that's had an effect on their total net income, because as you can see here, it's not really been a consistent upward trend on net income. It was at 12 billion at 2018, and for 2019 it's sitting at 7 billion. And as a result of that, you can see their operating margin is 15.67%, which isn't high. I typically like to aim for 20% and above. But I still think it's relatively safe. Alright, guys, I'm just having a look at the balance sheet information. The current ratio is sitting at 1.1. Total cash is 11 billion, and the long-term debt is 41 billion. Alright, guys, and looking at trading 212, just type in PEP, and there you go, you've got the PepsiCo. And to buy one share of PepsiCo, it's going to cost you £105. The next company we're going to be looking at is Johnson & Johnson, ticker symbol J&J. They're the world's largest medical conglomerate. You know, in terms of their footprint across the globe, they operate in 60 countries. And just taking a look at their revenue streams, they're very well diversified, unlike the other company that we looked at today. Their pharmaceuticals is representative of 50% of their revenue. Medical devices is 33%, and their consumer products are 17% of their revenue. And you know, some of these consumer products are familiar names: Listerine, Sudafed, Benadryl, and the list continues, guys. And in terms of medical devices, they don't necessarily focus on ICDs like Medtronics, but they do focus on more orthopedic type medical devices. So, oh, I was meant to say hip replacements there. Yeah, but hi, hi guys. But yeah, hip replacements, knee replacements. This is where they shine, and their pharmaceuticals again are patented drugs. Again, this Remicade alone, you know, accounts for 6% of revenue. In terms of competitive positions, they've held patents on a lot of these drugs and vaccines for decades, you know, and they do treat cardiovascular disease, neurological and infectious types diseases. Taking a look at Johnson & Johnson's dividend safety score, of course, it's sitting at 99. they've actually benefited from the current pandemic that's going on. So no surprise there with their dividend safety score of 99. As of today, they've got a relatively good dividend yield sitting at 2.80%, and their dividend growth rate has been it's a bit of a respectable 6.87% over the last 10 years. And taking a look at their dividend history, that's just beautiful, isn't it? I mean, if you if you'd invested shares in 1990, you would have just been eating beautiful dividends. So now they're offering a $1 a share that you own. Taking a look at their financials, guys, their PE ratio is sitting at 22. They've got really good income statement. Their net income has seen steady growth year on year, and that reflects on their growing revenue, which gives the company a respectable operating margin of 26.06%. They've got a healthy balance sheet. Their current assets is at 45 billion, and their current liabilities are sitting at 35 billion. Their stockholder equity growth hasn't actually, it's been in a bit of a decline, so which tells me that their liabilities are growing faster than their assets. Saying that, guys, with a current ratio of 1.31%, I'm very happy with that. I'm not really concerned, and also they've got a strong cash position, sitting at 18 billion, and the debt is sitting at 27 billion. Johnson & Johnson is currently trading at 7.9% below its 52-week high. And if you wanted to pick up a share of Johnson & Johnson on Trading 212, the share price will cost you £117.33. Alright, guys, so the fifth company on our list is Costco, ticker symbol COST. Love Costco. They're one of the largest sellers of groceries, alcohol, fuel, protein shakes. You can tell I love Costco, and they've been growing in terms of their store location, sitting at 775. Something that was surprising to me was their main revenue comes from membership fees, which they've seen a renewal rate of 90% in the US and 88% worldwide. So it shows that their members are quite loyal and they love their products. And of course, the next generation of revenue comes from the sales of diversified products. However, I am a bit concerned with regards to the rise of e-commerce giants such as Amazon and how that will affect the company's growth. But I still think with Costco, their dividends is quite secure. And speaking of dividends, if we look at their dividend safety score, it's currently sitting at 99, which again is the highest it can get. The current dividend yield for Costco is sitting at 0.93%, so they actually are the lowest dividend payers on the list. Saying that, in terms of the dividend growth rate, it's one of the highest. A 10-year growth rate is sitting at 15.28%. That's incredible, just from a 10-year period. Just think about compounding the dividends over time. That's incredible. All right, guys, so taking a quick look at their financials, they have quite a high PE ratio of 35. And to be honest, guys, I do think at a price of $304.80 a share, I believe it's quite overvalued in my opinion, and I'll be waiting for any dips or drops before I decide to buy into the share. But nonetheless, its 52-week range is only down 6% off its 52-week highs. It has an operating margin of just 3%. Now that is scary. And that's why, when I was doing my research and found out that majority of their revenue was from membership renewals, because their operating margin is so tight. And if they were to see a drop in membership renewals, that's going to severely affect the company's profitability. Total cash, however, and versus their total debt is probably nearly neck and neck. Their current ratio is just above 1. And when we can take a closer look, there you see it, their total current assets are sitting at 23 billion, and their current liabilities is also sitting at 23 billion. There's not too much in it. Nonetheless, their stockholder equity has seen year-on-year growth. And also, if you look at the analysts' estimations for the growth of Costco, you can see they factor in a lot of growth for Costco by August this year, even growth by next year of 7.30%, and even all the way to 2021 that they still foresee a lot of growth in this company. If you wanted to pick up a share in Costco on Trading 212, one share will cost you £247.28, which is ridiculous. That's expensive, guys. All right, guys. So that pretty much wraps it up. And our final bonus stock is Visa. Also has a dividend safety score of 99. And I've done a full analysis on Visa. It should be on the left or the right of the video. But yeah, check it out.
Alright guys, so that wraps up today's video. Remember guys, don't invest in a company that you do not understand the fundamentals, okay? Do your own extra homework, do your due diligence before you put money into any company. Don't just put money into a company just because of their dividend payouts. Make sure you do your assessment, do your homework, because remember, there is always risk with every investment you take. If you like the video, please give it a thumbs up. A lot of analysis went into this video, and don't forget to share it with your fellow investor friends or family, and stick around guys. We've got loads more videos, loads more content coming for you. I really enjoy making these, so hit the subscribe button below and I'll catch you in the next video. Peace.